In fact, we might even start a little earlier today. We have a big program for you, a very important, very relevant topic that we're going to be covering today. We have a lot of folks on the line, probably one of our most attended webinars to date. So quite frankly, you got about 60 seconds to find your chair, grab that last drink, and we are going to kick off a little bit early.
Yeah. Doug, I think the perk of having virtual meetings like this is that I'm pretty sure everyone is already very comfortable in their home or in their office with their lunch, very situated to, enjoy our speak.
Perfect. Well, on that note, then welcome everybody to San Diego Chapter's Lunch and Learn series for CCIM San Diego. This is where we promote excellence, competency, and collaboration. I'm your host, Doug Tabor, board member of CCIM Chapter of San Diego and rental property broker with KW Commercial, Keller Williams. I'm delighted to introduce my co-host today, Miss Paris Moe. She is a fellow board member and she is also an associate manager at Verdani Partners. How are you today, Paris?
I'm doing great. Lovely to be here with you.
Happy to have you, and thanks for keeping me on point with the tempo and the logic this morning. I appreciate it. All right.
No worries. Always a pleasure.
A few housekeeping items today. Attendees, of course, are in listen-only mode. We will be using the Q&A box for questions. We don't open the chat because we have so much to cover here, but we will have the Q&A box open for your questions. So please submit any questions that you have for the speaker in the Q&A. We'll try to get to all of them. We have a lot of questions that were submitted prior to the presentation, which we like to cover. So please go ahead and submit those questions to the Q&A. And then of course, the webinar is being recorded and a link will be shared to you through email after the event. So those are our housekeeping items. And our agenda this morning, as usual, we're going to open with the introduction, which we're doing now. This morning, we have something unique. We have a webinar sponsor, which of course is important for us here at the CCIM. So we're grateful to have that. We are going to recognize our annual sponsors. We're going to do our quick audience poll. We will then introduce our speaker for today's event. And we're not going to stop halfway through for questions, which is what we normally do, because the amount of topic that we have to cover, we are going to go ahead and have questions spread throughout the presentation. And our speaker today has a hard stop at 1 p.m. So we will be concluding at 1 p.m. on the button. All right, it's now my pleasure to introduce a new facet of our Lunch and Learns. We have a title sponsor today. We're going to take a moment to introduce Mr. Bob Telja, CCIM, MBA, Certified General Appraiser, and owner of Rocket Real Estate Services, which is a commercial real estate appraisal service. Bob has been in the commercial real estate industry for 12 years. He is a CCIM and a former broker with Newmark, Knight, and Frank. Bob volunteers on the San Diego County Tax Appeal Board and runs his own commercial appraisal firm. As Rocket Real Estate, he focuses primarily on the estate planning and off-market needs of private clients. Wearing many different hats allows him to appreciate the diverse and often competing interests in our industry as he strives to support his clients with unbiased market-based advice. Bob, welcome to CCIM Chapter's Lunch and Learn, and thank you for being our sponsor today.
Happy to be here, Doug, and happy to be wearing my CCIM pin.
Awesome. Yes. And I have mine on today, and what a joy it is to complete that journey, as you probably know. Bob, you and I had a good discussion last week when we were talking about, how you can participate in this event today. And, we were talking about really how an independent appraiser could work within the industry. A lot of times, obviously, the appraisers are really hired by the banks, they're handled by the banks. But in this situation, someone can hire an appraiser, someone other than a bank. I guess my question is, if an owner wanted a tax assessment review or an estate plan update, or maybe they were doing an off-market sale, what would, in your opinion, what really should an owner look for when hiring an independent appraiser?
That is most of what I do, Doug. I do almost no transaction work. And I'll give your audience two who's, one where, and one when. The two who's are, you do want a certified general appraiser. A broker opinion of value is great for preliminary planning purposes, but it's not going to cut it if push really comes to shove with the IRS or the local taxing authorities. They care very much about those credentials, and so you should too. The second who is, you want someone who has been involved in all facets of the industry. There's no substitute for brokerage experience. I'm sure you would agree with that, Doug. And ideally, you want a CCIM who's dedicated to improving our industry. In terms of where, you want someone local who has lived in the area, drives the comps every day, and worked in the industry locally for at least 10 years. I'm sure that some of you are aware our appraisal industry has gotten increasingly national, and many appraisers hold licenses in 5 to 10 states. But that's probably not the person you want to represent your interests the best. And lastly, the when, you want to hire that person as close as possible to the relevant data value. It can get both costly and inaccurate and difficult to defend if it's a decade later. So perhaps you want it within 1 year of a date of death situation, if it's in the state administration thing, or just prior to sitting down with your extremely valuable and expensive lawyer and accountant, you want to know what value you can defend for your assets. Thanks, Doug.
Yeah, you bring up a great point, especially, as a broker myself. I know that when we have a commercial property, oftentimes I get a request for, what would be the property appraised for. What are some of the ways a broker can really benefit from a relationship with an independent appraiser like yourself?
Well, of course, the biggest firms have their own in-house appraisers, and they do it for a good reason. There's a lot of synergy. But if you're a broker that doesn't have that service in-house, I was a broker myself. I know that those phone calls from those appraisers are not the first thing that put money in your pocket. But you should be aware our industry is getting tougher and tougher. More and more, there are off-market deals, motivations from owners, perhaps a proposed development down the street. You want to know about all those things. And one little takeaway tip for our brokers in the audience, most of you know to always ask an appraiser what the subject property is. But surprisingly few ask why the subject is being appraised. We can't always disclose that, but of course those motivations are the same sort of motivations you as a broker want to know if you are looking to do a deal. So always ask why the subject is being appraised.
Yeah, that's a great recommendation. And, we do get, I know I get the request of a commercial real estate appraiser quite often. Residential, they're a lot more prevalent, but I don't know as many commercial appraisers. So it's good that you've come on. At least you're going to go in my Rolodex. Much like your firm's name, valuations obviously have skyrocketed. Things are through the roof right now. Everything is going up. They say, 18% increases. There's half of the amount of multifamily properties that are 5 or more units on the market than are normal. A lot of stuff's happening off market. You bring a lot of experience to your business. I know, through our discussion, you're not only an appraiser, but you're an MBA. You have your CCIM, and you also own investment properties yourself. I know you mentioned that. As we wrap up, let me know, what are your thoughts on the current state of the market, valuations being where they're at? where do you feel this market is today?
Well, wherever you believe the market is going to go from here, I think many of us would agree that this is a time of greater uncertainty and greater change than most of us have experienced. Even in the last big downturn, when I was a broker at the time, there were a lot of problems for a lot of people, but we pretty much knew what was happening. I think we're at an inflection point right now. We don't know if raw material prices are going to keep skyrocketing. Just today, I heard some news in the opposite direction. Development deals are extremely tough to underwrite. We have a big social and political issue with the cost of housing. And we have an enormous potential change to our tax laws. And that's why I think so many people are interested in today's Lunch and Learn. I'm very much looking forward to our speaker today.
Wonderful. Well, Bob, again, on behalf of the San Diego chapter of CCIM, I want to thank you for your support. And to our audience, of course, if you're in need of a good commercial appraiser, someone who obviously brings a lot of experience into the business with them, Bob's information with Rocket Real Estate Services will be thrown out there with the email that we're going to send out, and his contact information will be made available to you. And of course, Bob, I think, is going to stick around, possibly if we have any questions throughout the webinar that maybe relate to Bob's services or expertise. He'll be in the background, and we might be able to pull him back in to share some of his insights. So thanks a lot, Bob, and we really appreciate you being here.
Thank you, Doug.
And as we move forward, for more information about becoming a CCIM designee, if you're looking for more information on future topics, or possibly you want to showcase your business and become a title sponsor at one of our future Lunch and Learns, please visit ccimsandiego.com. You can connect to our LinkedIn page and subscribe to our YouTube channel, or you could just reach out to us directly. All that information will be on our website, ccimsandiego.com. And now I would like to take a moment to thank our other sponsors, our annual sponsors, for their generous support. And I don't know if I'm a little off here, but now I am lined back up. So I always appreciate taking this moment to thank our annual sponsors. We wouldn't be able to stay afloat without them, quite frankly. And so sponsorships, again, we're really open to any sponsorships that make sense, that align with CCIM. So if you have an interest, please reach out to us. Our platinum sponsors, of course, annually are Heck Solberg, Marcusson Milchap, PMB Healthcare Services, Saville's Global Real Estate Experts. Our gold sponsors are CoStar, Exeter 1031 Exchange Services, SCS Engineers, and Slat Capital. We thank all of you for your continued support. And again, if you're interested in sponsoring the San Diego chapter of CCIM, please reach out to us directly. Okay, now one of my funnest moments of these Lunch and Learns is the opportunity to introduce our audience poll. So now that you know a little bit about us, let's find out a little bit about who's in the audience today. If you could just take a moment and complete the poll. All right, here we go. So we have owner investors, large percentage, brokers, a large percentage. We have some attorneys in the audience, some developers, some lenders, some property managers. Wow, we have really quite a diverse group today. But the winner of the race looks like the owner investors. We want to thank you guys all for attending today, and gals, of course, for attending the webinar today. We hope to continue to bring value to you. And quite frankly, this is one of our most well-attended events. So that being the case, I am delighted to go ahead now and introduce our speaker for the event. Our speaker today is Mr. Tim Tikalsky, CPA, CCIM, and principal of the firm Sensiba San Filippo. Tim is a CPA with 40 years of tax experience, specializing in real estate tax planning, compliance, and consulting for a variety of client types. Tim is a frequent speaker and contributor at a multiple of industry associations and was an adjunct professor of taxation at California State University, East Bay for over 10 years. Discussing with us potential changes in tax law, big topic, and their effect on real estate investments, please welcome our speaker, Mr. Tim Tikalsky. Tim, floor is yours, sir.
There we go. That phrase, you're still on mute. Thank you. So happy to be here. Happy to be presenting to fellow CCIMs or candidates for CCIM. A little history on me that's not in the present slide was I am currently the treasurer of our local chapter, the Northern California chapter for CCIM, and the incoming president elect for not this year, but next year. So I got introduced to CCIM. I've been doing real estate related transactions with my clients as a CPA for, as we said, over 40 years. But it really was recently that I focused on the industry almost exclusively. I would say that most, if not all of my clients own real estate in some capacity. It usually is, it could be even their main business. But I have an expression I like to say is that I don't have a hard time convincing my real estate clients that real estate is a good investment. I have a hard time convincing them it's not the only investment. So I spend a lot of time talking to my clients about diversifying their real estate portfolio. If they don't own real estate, why not get into it? I mean, real estate is a great asset. You get a deduction for an asset that's appreciating in value. So CCIM was actually key in me understanding the real estate industry. So if you are a candidate out there, I would tell you that taking 101 will be a life-changing event for you, especially if you take that back to your business and then pursue the pin. So anyway, thank you for allowing me to present. So what I'm going to do is talk about the world according to Tim, I guess, primarily, because a lot of the information that I'm going to be giving you is anecdotal, and up until probably 2 months ago was nothing more than campaign rhetoric. But it has now evolved into some formal communications that the White House has made. I will go over those. I will then try to go beyond what those are and try to pick out things that might be low-hanging fruit that aren't getting a lot of discussion. Then I'm going to attempt, time permitting, to then talk about things that you should be doing or you should be advising your clients to do before these changes occur. So we might be, we'll be discussing things that might be old techniques to you, or it might be a different focus, but certainly I think would help you advise your clients. Of course, general disclaimer here, I kind of think you would not be taking all of my advice. I don't think you'd be doing that foolhardily if you didn't consult your tax advisor or your tax attorney or preparer. So again, overview, I think I covered that. Time permitting, I may delve into more detail. One of the things I do want to highlight will be the rules regarding depreciation and bonus depreciation. I think that is something that is at risk. I'm getting a lot of questions, and I'm doing this presentation a lot lately. In fact, I have another one right after this. What should we be doing? And in a nutshell, I think I'm advising clients that if it makes economic sense to sell something, sell it. If it makes economic sense to buy something, buy it. Okay, I mean, that's about as simple as I can get. Rates are going to go up, capital gain rates are going to go up, deductions are going to go away. We need to be acting proactively with our clients before these things change. So I will attempt to go through that with you. So a little historical perspective, as I told you, I started my career 40 years ago. Which, if I can find the little laser pointer here, you are looking at right about here. So 1980s, when I graduated from college, marginal tax rates were 70%. Now, today's rate is, 37%, and as we will talk, that rate is likely to go up to 39.6, the pre-2017 change. But you can see historically that it's not, that 70% or even 39.6% is not the highest. We've got 1944, where the tax rate was at 94%. And actually a little historical perspective, not on the slide here, but 1913 was the first year for the income tax. You actually, this says the marginal tax rate was 7%. Well, actually, you were subject to a 6% tax rate if you earned more than $500,000 in 1913. If you were fortunate enough or unfortunate enough to have income less than $3,000, you paid no tax. And if you had more than $3,000, you paid 1%. So we've come a long ways, haven't we? So that will be a focus of conversation, obviously. And then the taxable gains, capital gains taxation has been fairly steady, except for a few years. But right now we are looking at a marginal tax rate. This slide is a little dated. It doesn't show the 3.8 Medicare tax that you would pay on capital gains if you sold property or an activity in which you did not materially participate. So stocks, bonds, and rental real estate activities in which you don't materially participate, if sold at a gain, are really taxed at a 23.8 tax rate. Again, a little historical perspective on the 3.8 net investment income tax, or some people refer to it as the Obama tax. So recall that rate came into effect when Obama wanted to pass national health care primarily, or the mandatory health care requirement. And I have a favorite expression by Ronald Reagan, who said that there's nothing more permanent than a temporary tax, right? The 3.8 Medicare was supposed to be a temporary tax. And in fact, you would think that would go away with the mandate for the medical going away. It has not. And it is not likely to go away. So again, nothing more permanent than a temporary tax. So I mentioned that 2017, we had major changes with the Trump administration. And what is probably not well known is that a lot of those provisions will expire. They're set to expire in 2026. Why is that? Well, it's primarily smoke and mirrors of Congress, because when they ever pass tax legislation now, they have to balance the budget. And they have to do that in a way that the revenue decreases will actually balance against the revenue increases. And they have a 10-year window in which they can do that. So in order to get these tax provisions passed, they must then have these provisions, in a sense, expire. And a lot of these will. So even though Biden hasn't mentioned, and we're going to go over some of the current rules, even though he hasn't mentioned that some of those are going to change, I consider that low-hanging fruit. So anything that was set to expire, certainly a benefit provision that was set to expire in 2026, is likely to be on the block for acceleration into at least 2022, if not maybe as soon as 2021. By the way, the other question I get a lot is, can they make these tax laws retroactive to the beginning of 2021? And the answer is yes, constitutionally they can. Politically, I think it would be very difficult, but yes, they could today pass a law that says the marginal tax rate on ordinary income is 39.6% effective January 1, 2021. Now that would cause an awful lot of problems because people have already, here we are in June, after June 15th, we've already had the second installment for estimated taxes due. How do you deal with that, right? People would be underpaid if they were using a 37% marginal tax rate. So you can see the impracticality of it. But what is interesting, and we'll talk about Biden's Green Book that came out just recently, he said specifically with respect to capital gains rates that he's going to ask Congress to make that rate effective for transactions after the announcement date of his plan. And the announcement date, as far as we know, was April 28th. That's when the Green Book was published. Actually, it could even be sooner than that because, no, I'm sorry, that's when the Americans Family Plan came out. The Green Book came out sometime in May. So we don't even know what that effective date is, but already we're getting implications that there might be some retroactivity to some of these law changes, all right? So let's talk about a little bit about what the current law is, because again, what Biden has said is he basically wants to take away everything, I'm paraphrasing, but he wants to basically reverse everything that Trump has done. So anything with respect to rate increases or decreases, you know, Trump lowered the corporate rate down to 21%. Biden wants to raise that up to 28%. We'll talk about that. But a lot of these current, just to remind you of what we had in 2017, because we had a major change in 2017 with respect to taxes, let's not forget. A lot of them were benefit provisions, but a lot of them weren't. So remember, we had the elimination of the deductibility of state income taxes. That caused a big hoopla across the states, especially in California. I mean, we are privileged to probably pay the highest marginal tax rates in any state. You know, next to New York. Used to be New York was worse than we are. I think we've surpassed them. I mean, you're looking at 12.3% highest marginal rate in California. So that is non-deductible. It is likely to continue to be non-deductible, even though that is one of those expiring provisions. Mortgage interest deduction was lowered, interest on mortgage interest from $1 million principal down to $750 with a grandfather clause for $1 million mortgages. So not to worry if your current mortgage is less than $750, excuse me, less than $1 million if you had a grandfather. And we virtually eliminated all other itemized deductions. You know, the only thing that's left is home mortgage interest, $10,000 on your state taxes, maybe a deduction for medical, but it really has to be major medical over a 10% threshold, and charitable contributions. So in the area of charitable contributions, by the way, from a taxation theory, that actually makes the most sense, quite honestly. Because to the allowing a deduction for charitable contributions it takes the burden off the government. So if you can encourage private citizens to make contributions to charities, that means less that the government has to fund, right? So it has been a long-standing good tax policy to allow for deduction of charity. So I don't see that being changed. We talked about capital gains. Again, maybe a little known fact, you know, we don't have a flat rate for capital gains. And by the way, corporations don't have a special rate for capital gains. And by the way, California doesn't have a special rate for capital gains. So this is just the federal. In federal, you could have a situation where an individual that has a capital gain may pay zero capital gains tax, depending on their threshold. It's a fairly low threshold, but it is a graduated rate, very compressed. that could range anywhere from 0 to 15% to 25%, or excuse me, I'm sorry, 0 to 10% to 15% to 20%, and then tack on the 3.8 Medicare tax. So that we will talk about Biden's changes in a moment on that, but did want to remind you that we have a graduated capital gain rate system. And then lastly, the one that I spend most of my time talking to clients about is what do we do about estate planning? So again, my client base, most of their wealth is tied up in real estate. And that means that on death, they are going to be subject to an estate tax at a rate of 40% if the value of their property exceeds the exemption amount on their date of death. And right now, the exemption amount is at $11.7 million. You can see it right there in 2021. Historically extremely high, right? In fact, you can see that we have been on an upward trend for the exemption. And again, to reiterate, what this means is if you have an estate that is less than this exemption amount and you haven't given gifts prior to that, then your heirs are not subject to a tax on the value of that property up to that exemption amount. The $1 that exceeds that will be taxed at 40%, by the way, okay? So planning becomes extremely important. And this is an individual designation. So in other words, each individual gets 11.7 million. A married couple is going to have 23.4 in 2022. But that is, again, on the block. So let's just talk about what Biden is talking about doing, having put the current law in perspective. So as I mentioned, corporate tax rate's going to go up from 21 to 28%. There's actually a bill that's pending right now that is called for that. By the way, a lot of these other provisions do not have bills pending. We're keeping an eye on that. Although I would say between, I think I have a slide on this, between the month of, I think in the month of April alone, just in a 2-week period, there were 32 bills that were proposed on the Hill for tax law changes. So things are moving. Alternative minimum tax, that is a tax that corporations, at least under the current law, don't have to pay. We have a 2-tax system, by the way. I don't even know that. You know, you calculate your regular income tax, apply the rates to it, and then you go to the alternative minimum tax and apply a rate to that. Certain things are deductible for all alternative minimum tax purposes, or for regular tax purposes, or for all men. So there's a 2-tax system. They eliminated that 2-tax system for corporations. They want to bring that back for corporations. We still have it for individuals with a higher exemption amount. Section 199A deduction, we'll talk about that time permitting, but that's the deduction that now you get a freebie. You get a 20% deduction off the top for active trader businesses and that are not qualified service businesses. And by the way, rental real estate generally is considered to be an active trader business. Now that was something that came in the 2017 Act, and real estate industry had to lobby really hard to get that. So prior to that lobbying, all trader businesses that were not incorporated were going to be allowed a 20% deduction. Why? It was actually to counter or to be congruent with the corporate income tax rate reduction. So what Trump wanted to do, since he was giving corporations a tax break, he also wanted to get individuals a tax break. That's what the 20% was for. So not in the current proposal, but scheduled to expire 2026, likely to be a candidate for elimination sooner rather than later. So a caution there. And also a reminder, by the way, if you're not taking the QBI deduction on your rental real estate, you should be, right? Individual tax rates, we talked about that going to 39.6%. Charitable deductions, again, not a major change, except they are talking about bringing back the PEAS limitation. which was the limitation that on individuals with high income are over certain threshold amounts will not be allowed to take benefits from itemized deductions, albeit now very limited, right, as we discussed, but they won't get a benefit of more than 28% if they exceed a certain threshold. Here is the estate tax exemption that I discussed. So that is currently, the slide's a little dated, currently at 11.7 million. He's talking about actually lowering that to 3.5 million. It is scheduled to actually go down to 5 million adjusted for inflation in, you guessed it, 2026, okay? So again, but he has specifically said he wants to accelerate that reduction of the exemption amount. And he has also said that he wants to eliminate the ability to step up the basis of the property on death. That is a huge one. That is a huge one. So right now, as you probably are aware, when you die, your heirs get a stepped up basis. So your property is stepped up to state date of that value. If you're below the exemption amount, yay, you don't pay 40% tax. Biden wants to raise that to 45%. And your heirs get a stepped up basis. So they can go out the next day, sell the property, no capital gain. He's talking about eliminating that. He's also talking, by the way, about not only eliminating that, but the mechanism by which he's going to do it is to tax at the capital gains rate, if you qualify for it, the built-in gain on death or gift. We'll talk a little bit about that again, time remaining. That one came as a little bit of a surprise. 1031 exchanges, this is getting a lot of press. Here we go again, right? So 1031 exchanges was on the block in 2017. Real estate lobby, very strong, successfully negotiated that at least to keep it for real estate. They did eliminate, though, the ability to trade your BMW for your Mercedes tax-free, or your, your Van Gogh for your Picasso, right? So personal property no longer can be done in a 1031 exchange, but real estate can be. Again, real estate lobby very strong. A lot of arguments for why it makes economic sense to allow for 1031 exchanges. And again, talking about tax policy. So the reason, and again, I think I've got a question that somebody's going to ask me, what do I think the chances are that 1031 will be eliminated? It's likely not to be eliminated. It could be curtailed, as Biden wants to limit it to those gains that are less than $500,000. But here's the rationale behind why Congress allows 1031s to actually take place. There is a tenet in taxation called the wherewithal to pay doctrine. I shouldn't say it's a tenet, it's a doctrine. It is bad tax policy to tax somebody on income or a gain in this case when the individual doesn't have the wherewithal to pay the tax, right? So if I take a property, sell it, turn around, roll all the proceeds over into another property, I don't have the tax, I don't have the cash to pay the tax. It's the same theory for an installment sale. If you sell a property and take back a note and the buyer is paying you on the principal. Well, under current law and with result of the wherewithal to pay doctrine, I'm not going to tax you on the receipt of that note until you receive the principal. I've got the wherewithal to pay. So it is likely that somebody will wake up in the Biden administration and say, this is really bad tax policy. We start taxing these transactions, not to mention the fact that that the real estate market would be decimated. I mean, not only the values of real estate would be affected, and who knows, they might actually go up because if you're restricting activity, there's going to be less inventory. But not only that, but what about the service industries that service the whole 1031 economy? your exchange accommodators, you know, maybe even appraisals. We had we have a speaker sponsor, you know, in an appraisal industry. I mean, all that's going to have a ripple effect on an entire industry. So I think they're going to be able to convince Congress to leave 1031 alone, but it may end up being curtailed at a certain thresholds. Okay, and then lastly, we've got capital gains, as I said. So here, I was talking to somebody earlier today, and they said, well, what's your advice? And I said, oh no, they said, well, what do you think the effect is going to be on individuals of these changes? And I said, well, you know what? As long as you don't make $400,000 in income, and as long as you don't have a capital gain of more than $500,000 or more than $1 million for a couple, then you're likely not to experience a tax increase. But outside of those parameters, expect an increase. In fact, expect a big increase. Why 400 seems to be the limiter, I have no idea. You know, but it is a theme that is repeated throughout Biden's proposals. I guess he feels that if a married couple makes more than $400,000, that's $200,000 per person. You know, you're wealthy. Well, we happen to live in California. I don't think you're wealthy if you make $200,000 a year, unless you have to buy a house. But you get my point. Okay. So as I mentioned, there was an update. And how am I doing on time? You're going to have to throttle me back, because I do want to get some planning opportunities.
We have about 20 minutes left.
Okay, so you're telling me I get to go to 1 o'clock.
Yes, sir.
With questions that sprinkle in for me. Okay, so as I mentioned, Biden came out with a what he called the America's Plan, America's Family Plan. That was on April 28th. That was then followed up with what we're referring to as the Green Book. So on May 28th. And what the Green Book did was kind of fill in the blanks on the America's Plan. But I can kind of paraphrase some of these very interesting things. You know, I think this probably summarizes this last slide. You know, high income workers and investors generally pay 3.8 Medicare. The presidency form of, no, I'm sorry, that's not the one. I want to get to the one where it says his fair share. Here we go. So he's saying that basically he wants to take away what Trump gave, which is the 37% bracket, go to the 39.6. He just feels that people are taking advantage of the system. Wealthy people need to pay their fair share. So again, I think I already mentioned the thresholds for 400 and 500 for capital gains. That's the slide that indicated how many bills we had just in this period of time from April 16th to April 22nd. Oh, by the way, big push for beefing up the IRS. And there actually is a bill pending on the Hill right now that will appropriate, you can see here, provide appropriations to the Internal Revenue Service to overhaul technology and strengthen enforcement. I think I saw a statistic that said if you or you have a client who has more than $1 million in taxable income, it is likely that your chances of being audited will increase about what would be the 14-fold, I guess, because right now, well, I should say 7-fold, because right now everybody has the chance of being audited across the board, a 2% chance. If your income is more than $1 million, it's likely that is going to raise to about 15%. And if I think it was over 5 million, you might be looking at about a 25% chance of being audited. So again, those were estimates given by the Biden administration. They just think that there's too many cheaters out there. Okay? I think what it is that the wealthy people, you know, have the ability to pay people to come up with very creative tax ideas. So that's probably the answer. So a couple of surprises that came out of the Green Book were this whole concept of taxing built-in gains on death or on gifts. So right now, if I give away a piece of property, say 10 years ago, 15 years ago, I bought a piece of property for $100,000 and it's now worth $1 million. And because the Biden administration is threatening to reduce the $11.7 million exemption down to probably 3.5, it makes good sense for me to spend that 11.7 and start to gift away property. And if I gift that property away, if the fair market value is less than the exemption amount, I don't pay a gift tax, and I certainly don't pay an income tax because there was no taxable transfer. But what Biden wants to do is tax that built-in gain on the gift or at death. I'm thinking that that's his way to then counter this whole stepped up basis on date of death. Because obviously if I'm going to tax, so when I give a gift, even though I'm giving a gift with a fair market value of $1 million, the person I'm giving the gift to steps into my shoes with respect to the basis. So as in my example, I said $100,000, I give it to them for $1 million, they have a basis of 100,000. So if they go out and sell that for the next day, $900,000 gain. Under this proposal, that gift, unless you met an exemption, would be taxed, taxable gain, $900,000, assessed on the giver, on the person giving away the property, which is how gift taxes are assessed right now. So that is as surprising, but what's even more surprising is the third bullet point, which talks about something called the 90-year assets. So in this scenario, what happens is if you have a flow-through entity that owns an asset that has not had a taxable transaction associated with it for at least 90 years, then what Biden is proposing to do is tax that built-in gain in 2022. Now, you might think this is a stretch, okay? As far as, well, how can you have a flow-through entity that has a 90-year asset? Well, it's very easy. My grandfather purchased a piece of real property they paid $100,000 for in 1940. And during his life, he did a series of 1031 exchanges, assuming that 1940 was the effective date, I don't know, but he did some 1031 exchanges. He rolled over equity. He then set up a trust for mom, when he died, and mom got the property tax-free, no stepped up in basis, no taxable gain. Then mom left that to, my father, who then left it to me. You see what I'm saying? And now there's been 90 years in which that original property that grandfather bought never was subject to a tax. That's what he wants to tax. Now, again, this is way out in left field. I got to tell you, nobody saw this coming. The likelihood of something like this happening, in my opinion, is probably pretty slim. But you don't know. You don't know. You don't know where the tide goes. So something, again, to be cognizant of. In the 10 minutes.
Sorry to interject here. One of our pre-submitted questions was asking about if you would advise the rental owner to do a 1031 exchange now, considering the changes that we're expecting, or leave to kids or grandkids for the step-up basis.
Well, I think it's a great question. And prior to the realization that capital gains rates were going to go up, I would have said, yeah, it probably makes sense given your situation, depending on the amount of the gain. But I think that people have a knee-jerk reaction to paying taxes. And the thing that drives 1031 exchanges is, I don't want to pay taxes. But when you think about it and run the numbers, A 1031 exchange is just kicking the can down the road, right? Because if you roll over 100% of your equity, you're going to get a carryover basis of the relinquished property. You don't get a stepped up basis unless you put more money into the transaction on the replacement property. So you get no tax benefit from the step up in basis. Now, had you in fact sold the property, you're going to pay capital gains rates, as we discussed, maybe 20% federal, maybe 23.8, certainly less than the proposed 39.6 marginal tax bracket, right? And if within the period, within the year that you sold the property, you turned around and bought replacement property, you're going to get a full stepped up basis in the replacement property. And through a technique called cost segregation, accelerated depreciation, you're going to be able to depreciate that property and get a potential benefit of 39.6%. So would you pay 23.8% capital gain to get a 39.6% benefit? Yeah, you probably would. So why would you do a 1031 exchange? And why would you do it, especially if that rate is going to go up, in a year that, if you ultimately sell the property that you replaced, it's going to be in a higher marginal tax bracket. So what I usually advise clients is you got to run the numbers. And certainly in a situation where you think capital gains rates are going to go up, and I think we are in that situation, you have to be very careful in kicking the can down the road. Another technique that's popular right now is a qualified opportunity zone investments. Same theory. I'm able to defer the recognition of gain on a qualified sale into a qualified opportunity fund, but in 2026, I'm going to pay capital gains rates on that, whether I am in the property or not. I mean, if you sell the property, you're going to pay the gain at that rate. But the point is, I've just told you capital gains rates are going to go up. So why would you kick it down the road? In fact, I've got at least 2 clients with qualified opportunity fund investments that we are talking about terminating those investments today, because we know that we'll pay capital gains at a 20% rate, and it's likely that if we wait till 2026, it's going to be higher. So it's a long way of saying you got to run the numbers. But 1031 exchange is not always the way to go. Not always the way to go. Okay.
Got it.
Yeah.
Following that question. So if they do that, will there be a forced sale because of the lack of step-up basis if the owner was to do a 1031 exchange?
Well, you're talking about if they eliminate the stepped-up basis on death. Is that what you're saying?
Yes.
So there are going to be, again, we're all speculating on what the finite rules are going to be with respect to this. There are some safeguards built in for, if I have to sell the farm to pay the tax, then I will have time to pay the tax. I'm sure those kind of provisions will prevail. So if he does eliminate the stepped up basis on death, there will be time to pay the estate tax. But it will be a burden. You will be forced to sell property, which is the reason for the stepped up basis in the first place. Actually, one of the reasons. The other reason is, how the hell do I know what grandpa's basis was in that property that he bought in 1940? Right? That's why I say that 90-year provision is probably ridiculous. The nice thing about stepped up basis on death is you get a fresh start, right? You don't have to prove what Aunt B's basis was in her B of A stock, you get a fresh start. So again, tax policy would dictate that giving a stepped up basis makes sense from a tax policy standpoint. I did want to, in the time permitting, because this is just a hot topic and I did refer to it, if you haven't heard of a cost segregation study or know of its benefits, let me run you through a simple example. So normally what happens is you buy property, If it's commercial property, you get a 39-year straight line amortization. If it's residential, you get 27 and a half. In an example where I paid $1 million for a commercial property and allocated 80% to the building because land is not depreciable, you're going to get a $20,000 deduction in the year of purchase. However, if you did a cost segregation study, because of the existing bonus depreciation rules, and conservatively speaking, you were allocate 30% of that purchase price to non-structural components, you're going to get over a $300,000 deduction in the year of purchase. Okay? Bonus depreciation is scheduled to go away, again, one of those factors, in 2026 with the curtailment, I think in 2025 or 24, goes down to 50%. So right now, we got bonus depreciation. If you buy a piece of property, you're going to get, for qualified property, 100% write-off. That's why I say, if it makes economic sense to buy property, buy it, place it in service. I had a client who owned a RV dealership. Actually, he didn't own the dealership. He released the dealership. He had the best year of his life. Right? I mean, everybody's buying RVs because they couldn't go to a hotel. He comes to me and he says, "What can I do? I'm going to have $3 million worth of taxable income. It's going to kill me." I said, "Well, didn't you consider buying that dealership at one point?" He says, "Yeah, I'm actually talking to the landlord right now about it. Why do you ask?" I said, "Because if you could close on that property by the end of 2020, and we get a cost segregation study that allocates at least 30% of that to non-structural components, you're likely to get about a $1.6 million deduction." And that's what he did. So he closed on that property December 30th, and we accelerated a $1.6 million deduction against his $3 million in income. And I'm a freaking hero because of it. But anyway, so if you're not familiar with cost segregation studies, you should be, and be recommending it to your clients. I have some other things that I could talk to you about. Again, this was a kind of a shotgun. This is only an hour presentation. Being a real estate professional is important as far as getting the maximum deductions. If you're not familiar with those rules, and we talked about estate tax implications, and I'm just out of time. I think I'm just out of time.
On closing, you have some really key pieces of advice. I mean, cost segregation, certainly a great piece of advice. But in general, I know there was a whole second half of your presentation for planning. What would be the one key piece of advice you would provide, or maybe a couple of these quick bullet points as we close out? We can push it right to the end for the next 5 minutes on planning, especially considering a lot of these changes.
Sure. Well, as I indicated, the cost segregation study, big opportunity to generate deductions, and deductions that actually exceed the income from the property. Okay, so it's conceivable that a first-year depreciation deduction, in my example, on a $1 million purchase, that's going to generate $300,000 in losses. It's very likely that that's going to exceed the income from that property. What do you get to do with that excess loss? And what you get to do with that excess loss really depends on your status as a real estate professional. And real estate professional is defined in the code as somebody who spends more than 50% of their time in real estate activities, and that exceeds 750 hours. I am continually amazed by practitioners and clients who don't recognize the fact that their clients are in fact real estate professionals. They spend most of their time managing and operating their rental real estate activities, and they have the opportunity to accelerate those losses, but they only have that opportunity if they designate themselves, they meet the criteria as a real estate professional. So I would definitely go back to your clients, challenge them on the number of hours that they spend in real estate activities, because they may be missing some opportunities. The other one is, I mentioned it, it's the estate planning implications of this. So what does it actually mean when I say, spend that $11.7 million deduction? There's an exemption. I give a quick example here of mom who owns $12 million in assets in a living trust. You know, dad's died a long time ago. She only has one beneficiary, her daughter. If she does nothing and dies in 2026, when the exemption goes back to $5 billion adjusted for inflation, then that estate is going to be subject to a $2.6 million estate tax. $2.6 million. Now, if instead of waiting until 2026, mom said, all right, I just want to give that property to my daughter now. I'll give $11.7 million. That's the exemption amount. That means I will, assuming no appreciation, will have a taxable estate of only $300,000. Tax on that is $120,000. What did you just save? You just saved $2.4 million in estate tax. Now, if that's not compelling in and of itself, okay, and you have to have the right facts and circumstances, but you know, again, clients are wealthy because of the real estate holdings they have. You have the ability to give that away today. Do it. Okay. That's all I got.
All right. Well, thank you so much, Tim. That was riveting, of course. Usually tax is kind of a sleeper, but these days it's become such a highlight of every discussion, it seems like. So thank you so much for that.
Well, I'm sorry to jump off because I got to do it again for another group. So
no, we appreciate
any questions or comments, and please email me. You have my contact information. I'll send you a copy of the slides. Have a good day.
All right. Thank you, Tim. And on behalf of CCIM San Diego, of course, a big thank you to Tim. That was a great talk. That was a great update. So much good information, certainly relevant. And I also want to take a moment to thank our sponsor, our webinar sponsor specifically today, Bob Telja of Rocket Real Estate Commercial Appraisal Services. Bob, thanks for being here and sponsoring this event. Both Bob's information and Tim's information will be circulated via email along with a replay link for this webinar to everybody who registered. So be on the lookout for that. And we have a special event coming up actually next Wednesday, June 23rd. CCIM Institute economist Casey Conway will be doing a special Region 2 presentation. You probably saw that come through on your email. We are here in Region 2 in San Diego County. If you haven't heard Casey speak, definitely an economist you want to listen to. He certainly brings some humor to his presentations and obviously some incredible expertise, as he is the CCIM on a national level economist for the Institute. So go ahead and be on the lookout for that registration. And of course, for our upcoming events, please, once again, visit ccimsandiego.com. You can check into our LinkedIn page. Don't forget our YouTube page, where we're going to be posting all of these presentations for you to review in the future. And again, if you or your organization is interested in sponsoring one of these lunch and learns, please reach out to us directly. We would love to have more sponsors, which obviously helps the entire organization. So thank you again to our sponsor today, Rocket Real Estate Services and Bob Telja. And that's all we have for Paris Mo, CCIM San Diego. I'm Doug Tabor. We hope you have a successful month, and we look forward to seeing you real soon. Take care.
Take care. Goodbye.